CRN.
AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome back to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us on your drive home.
Happy Thursday, we call it. Happy Thursday.
Drive Time Thursday. 800-516-1220 to call the show, 800-516-1220. We're getting a lot of emails lately. You can email the show, Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. I think Gordon likes getting more emails that have to do with like reselling homes, construction, and permit. Like you've talked about a lot about like renovating your house. We have an email today, in fact, that came to Gordon about renovating their duplex, and he wants to turn it into a triplex. I'm like, not a lot of renovation loans do that, but I think Gordon's going to go into a little bit more detail about that today. Very interesting show. One of the reasons why I think, Gordon, I don't want to say we've been waiting, but we've been kind of anticipating higher interest rates, and we're starting to really see higher interest rates. We haven't seen these rates since earlier this year, or last year, about April. We haven't seen the 10-year yield as high as it's been since 2014, and there's kind of no slowdown. There's a big sell-off in the bonds. We have the ECB saying that they're seeing a little bit of inflation, and they're not going to, but they're not going to be hasty on ending their program. But we saw we saw the Fed today say that they're looking at 3 more raises this year in their interest rates, and you start adding that all up, Gordon, and why? And then you have a ex-Fed president, I think of Atlanta, saying that interest rates should catch up to the normal range of where they should be based on yields and so on, and our yields should catch up. And so there's a lot of activity here. And I'm not saying that real estate's dead, but I think we're changing into a new environment. Well,
to use an old cliche, there's only 2 things that's guaranteed in life. That's death and taxes. But I can guarantee you in 2018 that we will have interest rate increases, at least 3 of them. We had 3 of them last year in 2017, and we're slated to get another 3 of them this year. Rates are going to go up. You have to plan for rates going up, because as rates go up, we always talk on the show, payments go up, interest rates on cars go up, interest rates on credit cards go up. You have adjustable loans, your payments go up. Everything goes up when rates go up. So you have to try to learn how to balance your economic calendar by preparing for these things, because we know it's coming. And if you're trying to do something or refinance now, you probably should get it now, because we are going to see higher rates, at least in the first.
Start early, start looking for the dips, get your application in. Sounds very basic, but yeah, get that application in. There was a quote from another mortgage guy that I kind of follow, and he was talking about how many people start shopping for rates, and they get a quote from one person, they get another quote from another person. By the time they get the other quote from the other person, the quote from the first person's no longer the rates have gone up. And it's kind of what's happening right now. But not only that, the people you're talking to might not be the person who can actually pull the trigger. So you really want to be all the way as far as you can in a transaction with actually committing before so you can say, okay, the rates are where they want to be, and I'm floating, but let's pull the trigger, and somebody can do it. It's really important that you have that kind of access to your mortgage guy.
It's very, very, very important. Actually, believe it or not, most people, if you look at the trend, when rates start to go up, there's a flurry of activity. When rates start to go down, the generosity within our minds think that they're going to go lower, so we're always waiting for that rate to go actually lower. Where our thought process is and our plan is, hey, listen, if it hits your targeted rate today, take it, lock it, move on. Don't hedge the bet, because we can't guarantee which direction it's going to go, and we don't know how long that rate's going to be around for. That's what we always tell our clients.
So a little bit of commentary on this. Mortgage rates moved higher today, extending their march upward in January after the Federal Reserve signaled that 3 rate hikes are likely coming this year, while expected by Wall Street. The commentary made during the Fed's meeting this year, in which it left rates unchanged, sent mortgage rates higher. Many observers expect the Fed to start raising interest rates in its March meeting. Depending on your scenario, you could see about 0.25% higher in rates than last week. The average lender is now quoting about 4.375 top tier, and most likely you might be at 4.5. Unless you can guarantee, like I said, that there's somebody there to lock the rate and you're floating, just be really careful.
And the other thing, Tony, we want to point out, when Feds are going to raise a rate, the market, in our business, we kind of hedged that before it actually happens. So right now you're seeing rates. We had 3 price increases today, midday price increases. So that means we're getting ready to hedge the bet. So when the Fed does come out with the announcement that rates will be higher, the market, it kind of absorbed the shock because it's already built in.
Ex-CEO for Wells Fargo said that abnormally low interest rates affect the number of people refinancing, and that interest rates have been manipulated by the Fed far too long, and they have to go back to normal. You could burst the bubble, he says. This is kind of rhetoric we're hearing right now. The Federal Reserve did not raise rates this week, but markets view future hikes as a near certainty. And this goes on and on and on. Right now, the 30-year fixed, according to Freddie Mac weekly survey, is 4.22%. That's up from last week. 15-year at 3.68, and a 5-year ARM at 3.53, all according to Freddie Mac weekly survey. Treasury yields tick higher, again, as the Fed says they see inflation pick up. And again, this is the theme I think we're going to continue on with the show. But what this means is a higher rate environment, Gordon. And what do? Refinances are going to take a big hit. We're going to see that pull back. And like I said, if you're considering a refinance, start early. Wait for those dips in the rates to lock. If you're purchasing, if you're already in contract, I would consider locking. You could lose that pricing pretty quickly.
And you can do extended locks. Most investors do offer 45, 60, 90-day out locks, so you can hedge your bet. If you're in contract right now to buy a new home and that house is not going to be finished until early spring, you can actually lock that rate in and still lock that rate in for 45, 90 days, 60 days to make sure that rate is still competitive when it comes time for you locking your loan.
Yeah, and not a lot of lenders will do that without an address. We actually do. We do, but we have a lender that does that. If you don't have an address, you can actually lock in for many, many months. Meanwhile, if you're kind of along for the ride, I do believe rates are still within the affordability range. A lot of people are concerned about that. But I don't think it's going to change the fact that many people, a lot of buyers and a lot of sellers are going to start thinking differently about what they're going to do, Gordon. Do we have more room to work with? Yes, I think we do as far as the amount of buyers that are out there. But I think the high end is going to take a kind of more of a hit than the more affordable ranges. And it's funny that I say this, up to maybe 800, 900,000, which still falls in the affordability range. I mean, but if you're looking at an $800,000 loan and you see a half a point increase in rate, that's $241 a month or $2,900 a year easily that you are paying more for the same rate or the same payment as you did 2 weeks ago.
And as rates go up, credit score becomes so much more important now because there are hits based upon credit score, and especially in the jumbo market. We consider 680 to be a low credit score in the jumbo market. Jumbo market is typically looking for 720, 740 scores plus in order to get those premium rates. So very important to always take a look at your credit. Take a peek at your credit. There's all kinds of online sources for you to go and verify your credit score, the credit cards. It might not be accurate, but it's a gauge of where you are. Very, very important to keep an eye on that credit score because it's going to affect your rate and it could affect your affordability.
You can always call the show 800-516-1220, 800-516-1220. And Gordon, you are so right. We always talk about some of the ways to get the lowest interest rates out there, and you don't always have to go in an ARM. You can just improve your credit. And if you're not out there watching your credit, then shame on you.
If you're doing cash out, you can buy your rate down. I have a client today. He's retired. I did his loan about 4 years ago. He's got some medical challenges, and he called today and wanted to borrow another $50,000. He was initially looking at an equity line, but the equity line, the rates and equity lines in the mid sixes. So we're looking at refinancing his 30-year fix and add an additional $50,000 on his principal balance, in which he can get that cash out to pay some medical bills. He's going to actually, in order for him to qualify, he's actually have to buy his actual rate down. Need to buy the rate back down to under 4%. It's going to cost him about 2 points in order to buy his rate down because he has an 800 plus credit score and he has a low loan to value. So all these strategies is what we do. That's why we're here to help every Thursday, and that's the reason why we do this show.
Again, you can call the show, 800-516-1220, 800-516-1220. I'm Tony Mendez. That's Gordon Hines. You can always go to our website, bayarealoansource.com. Pandora lays off 5% of its staff and shifts its focus away from California because it's too expensive. They're looking to save about $45 million annually in adjusted earnings before interest, taxes, depreciation, and amortization by moving their interest to places like Atlanta. What do you think of that? You all of a sudden have now the 5% layoff isn't all from the Bay Area, but all of a sudden there's many people just, they're gone.
I mean, I think
They no longer qualify.
in an overall strategy and manager company, people like to move to lower price markets. They're probably going to those lower price markets. The skill level for the employment is not there. The diversity in employment is not there. A lot of your premium employees don't want to move to those markets. So you got to be really, really careful where you move your company to if you're still trying to attract that skilled labor. And there's a lot of lower price cities around the country. Mississippi, Alabama, those states are very, very low in housing expense and overall cost of living. But you have to look at the population. How many percent of the population actually want to move to those places? That's what you have to look at. The overall picture is what's important.
So some of the hottest markets where people are moving right now, San Jose, which is crazy. Household income, 110,000. Zillow has a home value forecast of 8.9%. Raleigh, North Carolina is number 2. Seattle, Washington is number 3. Household income is 78,000. Zillow is looking at a home forecast, value forecast of 5.4% this year. North Carolina, Charlotte, Austin, Texas, Denver, Nashville, Tennessee, Portland, and there's one more. You didn't put a name on it, but yeah, you're seeing a lot of people, and these are where. It's called the hottest markets for 2018, including tech hotspots. So you look at Pandora, for example, and they're going to say, okay, Atlanta's starting to make more sense. Affordability. We can employ some people, give them some good pay, and they can afford to live there. It's getting a little harder in places like the Bay Area, and you're going to see more of this come up, right, Gordon?
Speaking of transfers, there's a client I did a loan for about a month ago. She actually bought her first house in Antioch. She spent a little under $500,000. She works for one of the big express companies, and she just got into getting a transfer to Atlanta. And she's ecstatic about getting a transfer because what she's telling me, she did a house traveling trip there last week. She's looking at selling a house here because it's a relocation. The company's going to buy her house, and she's looking at a house in Atlanta, 6,000 square feet for less than $400,000. So she's ecstatic about that. So everything is a balance. She said she's going to keep her salary, so she's not going to be losing any money, but she can afford that bigger house in Atlanta. Interesting.
Can I call the show?
More bang for your buck.
Yeah, more bang. That's certainly what they're looking for. I mean, there's definitely some strategies here by the CEO, Roger Lynch. He hasn't been there that long, but I think you look at this chart, it just goes down, 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 and finally you realize, I think they hired him like right there, and now we're 7.5% up today. But you start seeing something like that happening more and more often. Amazon's doing the same thing. They're going to find a place in the United States that I'd love to see that list get narrowed down to 10 pretty soon.
But Amazon just hired 130. So I just saw a newsflash. Amazon hired 137,000 employees in 2017. Incredible.
Always email the show, 800-516-1220, 800-516-1220. Go to our website, BayAreaLoanSource.com. This is a call-in show, 800-516-1220, 800-516-1220. So interest rates are kind of the theme today. They're going up. They've been going up for a while. We just saw between Friday and today, put those 5 days together, and it's been a very interesting run. It reminds me a lot of what was happening, Gordon, back in 2007, 8, 9, 10, 11, when we were just seeing huge jumps in either direction.
Well, the president likes to say jobs, jobs, jobs. We like to say rates, rates, rates. Stay tuned. We'll be right back.
This is Money 2.0 on AM 1220 KDOW.
I'm going back to my roots another day, another door, another high, another low. Rock bottom.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today on your drive time special as you're driving.
Every Thursday we're here 6 to 7.
So we love scenarios. We get them all the time. We get tons of emails. Of course, we pick and choose some of the ones that are, I don't want to say worthy. I think we could probably do.
That are worth sharing, I think.
They're worth sharing. This is Jorge in San Pablo. He has a 2-unit building with a workshop. This is kind of up your alley, Gordon. This is about renovations. And he wants to upgrade the 2 units that he has. You do some renovations and add a 3rd unit and turn the workshop, which he has in the back, into a studio. Says he has about 20% equity now and has very little cash to put into this. Can an FHA 2 or 3K work? Is there anything else that'll work? So there are 2 renovation loans that most people are going to use, 90-something%. and that's the FHA 203K if you live in the property, or you can use the Fannie Mae Home Style if you live in the property, or if it's a investment property. So I think the first thing, I'll just get it out of the way before you respond, Gordon. You can't add a third unit. You can't. You have to work with the original floor plan and then expand on that. The workshop's a little bit iffy if you're doing it at FHA 203K, because FHA 203K, it's got to be a straight deal. But Fannie Mae Home Style is a little bit more flexible. They have a little bit more luxury things that you can put into the property. What do you think? Do you think he should take the 203K? Because the rates are going to be a little bit better with the FHA, and but if he builds enough equity, then the Fannie Mae Home Style would be better.
I think the problem with the FHA 203K, FHA are really, really bullish. It's going to be bearish on illegal units. They don't like rooms without permits. They're big on that. So I would, if I'm a betting man, I'm comparing both programs. I think the Fannie Mae program is probably a better program if he's looking to add any type of additions to the property without going through the proper permit channels, the zoning, the whole thing. San Pablo is not as tough as most cities, so he probably needs to go down to City Hall, talk to the city planner, figure out what his options are. Off-street parking is a big deal. But a lot of the off-street parking rules now have been relaxed because of the auxiliary housing that the state of California is allowing.
So you think he might be able to get that? I think he said the workshop was not permitted. So if he gets that workshop permitted part of the plans, then you have a better chance of having that wrapped into the whole renovation loan.
Even though the workshop might not be permitted, but if it's a solid structure and he can show that the structure was there, he could probably get it grandfathered, and he might be able to convert the workshop into some type of living space, provided that there's proper accessibility, there's proper ventilation, he's met the proper side backs from front and back and side, and he has adequate parking.
So the basic strategy behind a loan like this, we talked about how he only has 20% equity. So he doesn't have a lot of room in there to pull the money out and then do the work. And he doesn't have a lot of money in his pocket to do the work. He wants to use the future equity or the future value of the property that will have the equity in it. So assuming that he stays at 20% equity, he might end up with the Fannie Mae better because it doesn't need mortgage insurance. FHA, it doesn't matter how much equity you have, you end up with mortgage insurance. So the Fannie Mae loan may work better. That was tough to say. But you also have, so the way this works is you let's say you have a loan on it now and your costs are $100,000, and let's say it's $300,000 loan plus that is $400,000, and then you have whatever the future value of the property is, and that's what they set the LTV to, their loan to value, and then they loan you the money based on that. And you get an architect, not an architect, but you get a consultant involved. You have your appraiser involved, and then you have your consultant, the guy who wrote all the plans, and you get everybody together, the contractor, and they put a bid in there, and then they present that to the appraiser. He writes it up as a future, what the house is going to look like in the future, and sets a value. Highly recommend, if you're looking at something like this, to start working with your FHA or your Fannie Mae specialist first, so that you can look and see what is actually allowed under these programs. That's one of the biggest mistakes people make, is they don't work with a consultant first, and then they, that way that they are planning on doing a workshop, for example, like Jorge, and end up not being able to do it. And he spent all this money on plans. He has to redo them, go to the county, get them permitted, and so on.
I would actually have him check with the county first. I would have him come to check with the county, city, zoning, what the options are first, and then he can decide how he can do it. Because if he can actually get a third unit out of it based on future value, a 3-unit building is going to appraise for more than a 2-unit building, especially because there's rent's involved. So he'll have a shot at getting his MPV down even lower. So that's why I would start with the city, start with the county, San Pablo, some of the parts of that city,
and then see what can fly with
the county. So you might have to go to the county's office and start there, and then tell them what his options are.
And these are great loans. We do them all the time. You're welcome to shoot us emails about this, and thanks for the email, Jorge. It's Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com, which this one went to. You can always go to our website and learn a little bit more about renovation loans. Fannie Mae has it's pretty hard. Unless you knew what it was called, it would be pretty hard to find. It's called the Fannie Mae Home Style Loan. Again, you're also welcome to shoot us an email, Tony@BayAreaLoanSource.com. We'll come back after this break. We have a lot more to go over with you guys. Home builders, we're going to talk about, is this the best time of the year to rent? The average U.S. home seller is profiting more, as that's at a 10-year high, so there's plenty to talk about. We'll come back after this break here on AM 1220. I'm Tony Mendez. That's Gordon Hines. You can always visit our website, BayAreaLoanSource.com.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report.
That's Tony Mendez, and I'm Gordon Hines.
What's on your mind?
Happy Thursday. I'm happy.
What do you think of interest rates? Do you think this is going to cause any ripples through the, the market, especially a place like the Bay Area? I mean, I can understand if you're in a smaller market, say you're in Sacramento, or which it really isn't a small market, but it's lower priced homes, and you can stay conforming. You're not dealing with high balance conforming. You're not dealing with jumbo. You're not dealing with portfolio loans. You're strictly FHA or Fannie Mae conforming limits, and you're going to get those lower. You can stay in the low fours. And by the way, FHA is still under 4% right now. Do you think, like the Bay Area, do you think it's going to have a ripple effect in the higher priced homes, middle priced homes? Certainly not the lower priced homes, because we don't have any more.
Well, we've been spoiled for low rates for a long time, going all the way back after the crash of 2007. This is 2018, so 11 years of low rates averaging under 4% for a 30-year fix. No type of adjustable is going to outperform that. As the rates go up, of course, there are going to be ripples, but I think they're knee-jerk reaction ripples. I think nobody likes change. So anything time go up, people start counting pennies and become bean counters. If you become a bean counter, you start to get defensive. You say, well, maybe I don't need to buy the house. But those high-priced homes, most people put down a good-sized down payment. Most of the deals that we're doing, when we're doing the $800,000, $900,000, we're not doing 3.5% down as in the FHA market. We're doing 20, 25, 30% down. At the transaction I'm doing right now, a guy's buying a house for $600,000. He's putting out 62% just because he wants to hit that target for a payment. So people like that have a high cash flow. So I don't think that's
there is that one benefit of stepping up from one house to another. You're upgrading or even downsizing, is that you're carrying a lot of equity from the other house. It's getting a little bit harder now, though, if you want to turn that departing property, and we use that term all the time. It's the house you're leaving. If you're and turn it into a rental, because a lot of people need that equity out of the house. In fact, we got an email from Sam. He has a lot of equity and wants to buy a new house. His realtor says it's unlikely he won't be able to buy the new house contingent on the sale of his other property, which means that he's not turning it into a rental. He wants the equity out of the house, but he won't be able to buy with a contingent sale, meaning he has to sell that first. And he has only about 5% down. What are the options that are out there? And so this kind of is right up what we were talking about. How are you moving that equity from one house to the other without selling the other house first? There's not a terrible amount of options. Unfortunately, bridge loans don't. If you hear bridge loan, you might as well just replace that word with private money loan. There are no bridge loans, but there are something called cross collateralization loans. That's where they take the value from your departing house to the value of the new house plus your down payment and plus the equity, and they go up to 90% of the combined value. They don't qualify you on the departing property. They assume that you're going to sell that, and you move into the new house, and then you sell that house, and then you take that equity and you pay off the loan, you refinance or something like that. That's a cross collateralization loan. There are also a lot of low down payment loans. We have jumbo loans that go up to $2.5 million with 5% down. Yes, you have to have a good credit score. Yes, you still have to qualify for that house and the departing house. That's why that cross collateralization loan works really nice. And if you can stomach that, and you can maybe turn your house into a rental property for 6 months or a year and have that wash out some of that debt, and you have that 5% down, there's a lot of lenders that will do that. Be careful how you present that. That's all I can say.
Yeah, it's a tough transaction. It's a tough thought process. Most investors right now in a hot seller's market, no seller wants to accept a contingent contract unless you write that contract with no contingencies whatsoever and put your deposit at risk. But the program you just mentioned is probably a great program. Like you said, you do what we call a cross collateralization loan. The investor puts a note on the house that you are buying, and he puts a note on the house that you're selling. They're both tied together. The equity is kind of blended together. When you do sell the house, the proceeds from that house go to buy down your loan with the house you just purchased, and you kind of get the both worlds.
It's easier,
higher,
it's a slightly easier transaction.
We can make it happen.
It's a little bit better than doing like an equity line or refinance cash out. Then you're tying up a lot of equity in a lot of debt in that house. So you still have to cover that, and you have to figure out ways to do that. That's what we're here for. You can always shoot us an email, Tony@BayAreaLoanSource.com, or you can go to our website, BayAreaLoanSource.com. We'll be right back after this break here on AM 1220 KDOW.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. You can always call the show 800-516-1220, 800-516-1220. Millennials are making another top 10 list here. Contrary to popular opinion, millennials are still buying homes today at the rate of homeownerships that we haven't seen in a long time. So 13% of the United States population is a millennial, age 25 to 34, and they accounted for 30% of all home purchasers, and they make up the top homebuyer demographic cohort in the United States, according to the National Association of Realtors. Where are they buying? Where are millennials expected to buy homes in 2018? Kansas, Olathe, Chesapeake, Virginia, Bakersfield, California, Sioux Falls, Anchorage, West Valley City, Utah. A lot of small places. But some of these rates are looking pretty good for growth over the last, over the last 10 years. They're seeing pretty steady growth in these cities. Millennials are figuring out that they want to buy a house. 72% of millennials that rent say they want to own a home, and they're figuring out places to go, Gordon.
You know, I always get confused when I hear these surveys. They sound good in theory, but in practicality, I'll have to disagree. I don't know any millennium young person that wants to move to Bakersfield, California. There's nothing in Bakersfield. Bakersfield is a dry town. I think there's a military base there. That's about it. That's the only reason why Bakersfield is actually on the map. But I don't know if people looking to rush to Bakersfield, especially a young person.
See, I would say Anchorage would be, and Sioux Falls.
Sioux Falls.
Yeah. There's some places I wouldn't move, but I think Sioux Falls is part of that oil phase that everybody's, or the
fracking.
The fracking and all that stuff.
I think Citibank or one of the big credit card companies have a big position up in that part of town up there in North Dakota. But we'll see. Surveys are surveys. You got to always qualify the survey. A lot of stuff we get on the web, we always talk about. There's a lot of information out there. It's hard to separate fact from fiction. That's why when you're going to search the web, you talk about a loan, you want to check on something, you got to go with more than one source to actually validate the information, because the information is all over the place, and you got to be able to qualify it and quantify it to make it work for you.
If I was a millennial right now, which I'm not.
Well, you're a senior millennial.
I'm a senior, yeah. I just made Generation X. I would consider looking at places like Atlanta, places where big companies are moving into. We saw Reno, for example. Tesla and a lot of other companies are starting to think that Nevada's got some pretty good state tax laws for big companies to move in there. And I'd kind of follow that trend. And a lot of these the amenities that you're looking for can be found in these small cities across the United States. I'm not surprised at all about the little place in Utah. I'm sure it's some suburb of Salt Lake City, but you start looking at the incomes that you can get there compared to the affordability of that house, and all of a sudden it starts making sense, and you own a house. And I'm going to follow this up with another interesting stat.
Well, one key piece I'd like to add to that is that's important as well. You said Atlanta. You have to look at employment opportunities is key. When you just get out of school, you're looking, where can I get a job? Then after you say, I can get a job someplace, where can I get a high-paying job? Because much of these students are coming out with high student debt, and it's kind of really hard to go to a small town and get a great job that's not paying enough money. So it has to be a balance. It has to make sense. You have to do your homework and find out which is going to be better economic advantage for you, regardless of the cost of living.
Some of the numbers are looking pretty good over the 10-year high for home seller profits as of the fourth quarter of 2017. Adam Data Solutions, they say that in the end of 2017, we saw a tick up from 2016 and the year before. And all of these quarters, we see big. $54,000 is the average home price gain since the purchase. $54,000 average seller profit represents about a 29% return on investment compared to the original purchase price. That's up from the previous year of 28% and up from 26% in 2016. It's the most profitable time to sell a home in more than 10 years for home sellers, and homeowners are staying put longer than we've ever seen. While home sellers on the West Coast are realizing the biggest profits, rapid home price appreciation in red states markets is rivaling that of high-flying coastal markets and producing sizable profits for home sellers in those middle American markets. So we see this drive towards these profits, and we're seeing there's nothing like buying a house, and then a couple months, maybe a year later, you see that same house sell for $20,000, $30,000, $40,000, $50,000 more. Now, of course, in the Bay Area, we've seen that significantly more.
When did that survey come out, may I ask?
Today?
Today. Okay, that survey came out today. We're ahead of the curve. We've been talking about that now for weeks and weeks and weeks. We always say now the great time to sell your house. But of course, the problem is where you're going to go to. If you're trying to scale down in the local market, unless you're going to leave the state, it's very hard for any senior to take advantage of the profit market and sell their property because it's hard to scale down. So you're going to sell your house, where you're going to go. You're going to buy something in another state, you can't stay around here. Scaling down, there's no such thing as scaling down. And that's all with the challenge. You got to find that balance economic at. You got to find what works for you. And that's the reason why a lot of people are actually that want to sell but won't sell because they have no other alternative to go to move that money into.
That even works with Prop 13, for example, and you have a senior that's owned a home for a long period of time, and they may be forced to stay. And then you look at interest rates going up. It's going to cost me more to move. I carry that same loan, but my payment might go up, even though I'm bringing a lot of equity in there. You just get you're just getting a better house for a little bit more every month. So where is that economic fine line? And I think people are a lot smarter about the way that they approach buying houses. I think millennials today have a lot more options than they did 10 years ago. You have to remember, 10 years ago was the beginning of our mortgage meltdown, and basically every fantastic product that you could use to buy a house, 100% financing,
Evaporated.
It's gone. And we're seeing these come back. We talked a little bit about low down payment products, probably not enough. If you're making $120,000 a year and you're a first-time home buyer, you can put 5% down on whatever you qualify. Let's just say it's a $800,000 house, and you can get a decent loan. They don't even have mortgage insurance on some of these products.
Well, we have that great program. After there was a realtor I called today. I was just following up with him, a client we pre-approved for him about 3 weeks ago, and I said, "Hey, Mr. Realtor, what's going on with the client?" He said, "Well, Gordon, she had a financial tragedy over the week, or about 3 weeks ago. She had to spend her money. Now she has no more money, and now she needs to buy a house." I said, "Well, don't forget, we have the 1% down program up to the conforming loan, which is $453,000. So he said, "Wow, I didn't realize that." Yep. So now she's back in the game looking for a house because she has good credit, where she can put down 1%.
Interesting product.
$500.
The lender, you're actually putting 3% down, but the lender's contributing 2%, and they're allowed to do that, contrary to what a lot of people think. And there are low down payment products out there. Again, we're talking. This theme today is higher interest rates. If you want to get the best rate out there, you have to have a good credit score. Go out and get Credit Karma. Like today, 50% of the people that are out there walking around don't even know what their credit score is. You've got to start with managing your credit. Start looking at the ways to get rid of that bad stuff that's on there, and talk to the professionals.
If you want to call us about that 1%, you need a minimum credit score of 720. You can send us an email. We can get you pre-qualified right over phone or right by email. This is Gordon and Tony. We'll be right back in about 30 seconds. Stay tuned.
.com/backup. This is Money 2.0 on AM 1220 KDOW.
Come with me now. Come with me now.
Welcome back into the Real Estate Report. My name is Tony Mendez.
And I'm Gordon Hines.
Thanks for being with us today. Some of the other news out there: private residential spending reaches a cyclical high. It's up another 0.5% in December to a seasonally adjusted rate of $526 billion, the highest level since March of 2007. Any signs we're hitting a peak? We're going to hear a lot of how 2018 sounds and feels like 2007, which doesn't really scare me as much as it used to. Pending home sales tick up a little bit, 0.5% in December. That's some news out there. Home builders just had their nastiest 7-day run in 2 years. A bunch of sell-off there, I think, Gordon. Home builders had a great run over the last couple of years, and we saw, what was it, about a 9 or 10% sell-off on their index. So home builders are getting stung right now, but I think that'll come back. A little bit of fear of interest rates. Is this the best time of the year to rent? Yeah. According to some stats that were done by...
Here you go with those stats again.
Yeah, you love my stats. People like lists, So this was done by RentHop, and they see an average about 3.6% cheaper to rent during the winter, the February months, Novembers, the Marches, and so on, Decembers, and so on. In pretty much everywhere across the United States, they're seeing rents 3.5% lower.
Yeah, it depends on what region of the country you are. It depends on how close you are to amenities, which suburbs or metropolis you are, and that's depending on what your rental rates are going to be. This is the time of the show we always talk about this year in history. Two things I found today, believe it or not. 1884, the first Oxford Dictionary was printed. That's the world-recognized dictionary for English, the Oxford Dictionary. The only thing I can find in 1887, one of the most famous cities became unincorporated Los Angeles. You know what that is?
Riverside.
Hollywood.
Hollywood. Okay.
Hollywood. The Hollywood city was born in the Hollywood sign, and that's the mecca of Los Angeles. You ever see that Hollywood sign? You think L.A.
How many Hollywood signs do you think there's been?
I mean, Hollywood
Signs.
I don't know.
Something like 12.
Is it 12?
Yeah, it's a big number. It's a lot bigger than I thought it was.
Okay.
So they've replaced it several times.
So there you have it. There's Hollywood trivia.
Hollywood trivia. Somebody correct me on that, I'm sure. Give me a call, 800-516-1220.
Or send us an email.
Tony at BayAreaLoanSource.com. This is a really interesting story about private residential spending reaches 10-year highs, 6.2% over the year. And then increased after increasing 12.5 in 2016. The monthly gains are largely attributed to the increase in multifamily construction. But we're seeing private residential spending just skyrocket right now.
Yeah, because everybody wants to get rich, and the fastest way to get rich is to buy a house. If you see on television on the Home and Garden Show, there's all these fix-up programs. There's Fix Up Atlanta, Fix Up Georgia, Fix Up California. There's Fix Up everything, and that's the trend. That's why we got a lot of emails about people looking to renovate, want to ask questions about how you buy and flip a house. There's all kinds of programs out there. TV makes it look really, really simple, but it's actually a formula. It's not as easy as most people think. You can actually lose your shirt. So we always recommend working with a professional or doing one with someone at first, so you can get the hang of it to make sure it's going to be a proper venture for you.
So if you have any questions about renovation loans, we talked about Fannie Mae Home Style product. That's for owner-occupied and rental units. The rental unit has to be 1 unit, though, or FHA 203K, and that can be up to 4 units as long as you live in it. Those are great renovation products, and you can pick and choose which one you think would work better based on your scenario and credit score. You can go down to 620 credit score, I think, on the Fannie Mae Home Style.
And if you're unsure, you can always call us because we can point you in the right direction. We have a lot of these companies that we work with have professionals that come out and lay out the program for you, lay out what you'll need, how much money you're going to need, what the cost is going to need, who you're going to have to consult with, the contractor, the consultant, how to shop for deals, and how to make money. And that's what we're here to help you.
If you have any questions about low down payment products, you can always send us an email as well, Tony at BayAreaLoanSource.com. There's a lot of low down payment products up to $2.5 million on residential property, everything from even investment property. These products are starting to come out of the woodwork. And it's allowing a lot more people to get interested in and qualify for homes. We'll come back next week. Thanks for joining us. You can always visit our website, BayAreaLoanSource.com. You can always shoot us an email, Tony at BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. Thanks for being with us. I'm Tony Mendez. That's Gordon Hines. This is